Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. In today's video, I'm going to be reviewing my February 15th energy update. In my last report, I said the path of least resistance appeared to favor higher prices, but the direction of pricing near term would be influenced by the weather through the end of March. If it was colder than normal, natural gas was poised to move higher. And I also pointed out the long-term risk had increased due to our present administration's restrictive energy policies, aggressive fiscal spending, and quantitative easing by the Federal Reserve. And those factors collectively increased the risk of inflation in the United States. But since my last report, February has been warmer than normal, and NOAA is forecasting warmer than normal weather will continue through February 23rd. And the warm weather in February caused natural gas pricing to pull back from recent highs, which you can clearly see in this chart. In today's report, I will summarize the risk factors supporting higher natural gas prices and why I believe the risk-reward factors favor hedging your cost of natural gas and electricity now for protection against higher prices is a better option than delaying, hoping for lower prices later on. First, I will again summarize the risk factors supporting higher natural gas prices. In my January 31st energy update, I discussed two factors supporting recent price increases in natural gas and why those two factors increased the risk prices would continue higher near term. The first factor was natural gas supplies were forecasted to plunge approximately 16% below the 5-year average by February 14th. But warmer than expected weather in the first half of February slowed the draw of supplies. And by February 18th, we are now expected to be approximately 12% below the 5-year average. And with warmer than expected weather expected to continue until at least February 23rd, prices have pulled back from their recent highs. But it's important to note, supplies are still significantly below the 5-year average. And with liquefied natural gas exports overseas remaining at record levels, it appears we'll again be at least 16% below the 5-year average at the end of February. The second major factor is Russian troops are massing at the Ukrainian border. In my last report, I said if Russia invaded the Ukraine, any possibility the Nord Stream 2 pipeline would be approved by Germany near term would evaporate, thereby exacerbating the severe energy crisis in Europe. And exports of liquefied natural gas from the United States would continue increasing at a record pace. Our intelligence agencies believe Russia will invade the Ukraine, and it's becoming more likely they'll do so. And although I believe the invasion of the Ukraine will take place until after the Olympics, they're massing 130,000 troops at the border leads me to believe they will likely start their invasion shortly thereafter. Clearly, the risk factors discussed in my January 31st energy update remain, and risk-averse hedgers should consider the recent pullback an excellent hedging opportunity. Next, I'm going to be discussing why I believe the risk-reward of hedging favors protection against higher prices over lower prices. When I evaluate a market, I always consider the upside risk versus the downside reward potential of lower prices. This chart will help you appreciate why I believe the upside risk is much greater than the downside potential of waiting, hoping for lower pricing later on. In my November 16th energy update, I introduced the concept of Bollinger Bands, which is a technical indicator calculated by plotting two standard deviations above and below the 20-day moving average. They often highlight areas of support and resistance, and 95% of the time, prices remain within two standard deviations from the 20-day moving average. And if you look closely at this chart, you will notice there were 5 times since April 2021, natural gas declined to the lower Bollinger Band before rallying higher. There was only one instance when prices immediately fell below the lower Bollinger Band, which is consistent with the observation prices normally remain within the upper and lower Bollinger Bands 95% of the time. Therefore, if natural gas declines to the lower Bollinger Band, although nothing is guaranteed when trading markets, there is a high probability prices will hold near the lower Bollinger Band before moving higher again. But given the risk factors delineated earlier, I don't believe it is wise to hold off hedging now, hoping for a slightly lower price near the lower Bollinger Band. This morning, the Labor Department reported the Producer Price Index, which measures inflation at the wholesale level before it reaches consumers, surged 9.7% in January from a year ago, which was slightly below the 12-year high of 9.8% in November and December. Clearly, the threat of inflation is not abating, and 3 years from now, you may look back and realize there was only one cost of doing business you could have avoided increasing and avoided the volatility: your cost of energy for natural gas and electricity. Hopefully today's video helped you understand why I believe the recent pullback in natural gas is an excellent opportunity for you to protect yourself against the risk of higher pricing in natural gas and electricity long term. And until my next report, please take care.